Hey, good afternoon, everyone. Keith Uthe here with Mortgage Alliance Enrich Mortgage Group. And I am fortunate here to have someone who's got some extensive knowledge and is going to help give us some understanding and direction around beneficial trusts and using them in real estate investing. So with us today, we've got Irfanali Moledina, and he is with RMI Chartered Professional Accountants, and he is a CPA and CA located here in Calgary, and he's got a plethora of knowledge that he's going to share with us today. Welcome. Thanks for coming and doing this for me.
Sure. Thank you for having me. I'm looking forward to it.
Excellent. Excellent. Well, you know what? Let's jump right into it. And, one of the most common questions that I hear from real estate investors in conversations, whether it's clients of mine or on real estate investing groups, is when does it make sense to have an investment property in a corporation? And I know that the easy answer to that is, well, it depends. But are there any things that you would say are considerations of what might be triggers for them to make sure they're having a deeper conversation with their accountant about that choice?
For sure. Yeah, it is such a common question that comes in. And the biggest factors that I really look into is, first of all, what is the individual's income and main source of income? So, for example, if they're self-employed or already have a business, if they're able to keep that their funds or their savings inside the corporate structure, there's potential tax savings there rather than take that income out personally. So that's one consideration we always look at. The other one is how much income are they earning on the personal side? If you've got an employee who's got substantial income, 150, 200, 300,000, they're in a higher tax bracket already. And so at that point, it may make sense to look at that corporate structure so they're not taking any extra income in from the rental properties they have. And the biggest is, what are they doing with the property too, right? Is it going to be something where they're going to be flipping the property? That again might lead to saying, let's keep it inside of a corporate structure. Are they doing long-term rentals or are they doing short-term rentals, right? Like Airbnb, and there's different tax structures as well on those ones. So those are the biggest factors that I really look at is kind of what's their personal income at today? Where's the down payment? Where's the initial money coming from the investment piece? And then of course, what are they doing with the property at the end of the day?
Excellent. Well, as a mortgage broker, for me and for my clients, the biggest thing we run into is how lending rules have changed. The days of being able to buy rentals and put them into a holding company and get the financing and all things are glory and golden and away we go, that's changed. It's not your grandpa's lending environment anymore, or your dad's lending environment, whatever you want to call it. And so now there is, the beneficial trust conversation is certainly one that you and I, when we talked about this, is one that is coming up more and more and more. And the biggest thing I think is a lot of people don't understand what is a beneficial trust, and then when can it be used? So let's start with, what is a beneficial trust?
For sure. And it is becoming more common because clearly the banking rules have made your guys' job so much harder. So what tends to happen a lot of times is you take an individual who's got really good income and the banks want to just lend to them personally. So what we do is turn around and we institute this beneficial trust. And what it is, it's a document that says that the property is in an individual's name in trust of the corporation. And now why this is so handy is a couple reasons, because the banks and lending look at title ownership. So they're going to be concerned who's on title. So if we do this trust agreement or the beneficial trust agreement and it's in the individual's name, CRA on the opposite side looks at beneficial ownership. So that document then says that the benefit is going to the corporation. And because the benefit is going to the corporation, we're able to actually claim income and expenses under the corporation, even though the mortgage and the property is in an individual's name. And that just allows us to look at different scenarios where it's easier to get the mortgage qualified. You get the better rates because it's still in the personal name, but we're taking advantage of being able to do everything through a corporate structure at the same time.
And so is that beneficial trust, does that have to be then registered on title, or is it just something that needs to be kept and recorded in your documentation?
It's something that needs to be kept and recorded in your documentation. It's really important if CRA was to ever come back. It's handy if you do register it on title, but it's not required. It's something that just has to be there. So when CRA comes back to say, okay, well, who is the owner of this property? Who is getting that benefit at the end of the day? So where the income goes, we need to be able to provide that document.
So when can it be used, or when should it be put into place? So as an example, I'm not sure if, I'm buying this property and I'm not sure if it's going to be personal or whatever. Do I need to declare it? Do I need to decide that, the day that I get the mortgage or the day after? Or is it really, I need to decide before I file my taxes for that, in this case, for 2022?
Yeah, and I would say it's something that you should decide when you buy the property. Because a lot of times you also want to make sure everything tells the same story. So what will happen is if you want to treat it under the corporation, well, you have to make sure the corporation exists, right? So if somebody buys it under their name, they don't have an existing corporation, and then tax time comes and says, well, I should have done it that way, you won't be able to, right? So it's important to do it right away. Another good reason why is if you are going to do it through the corporation, you want the rental agreements to showcase that. You want the money to be flowing through the corporation at the end of the day, right? So you got to make sure everything's telling the same story at the end of the day. Otherwise, CRA can come back and deny it.
So if you're getting new leases, you need to make sure that your leases are in the corporation's name, not your personal name as well.
Absolutely, yeah.
See, there's a huge tip for you investors out there that want to use beneficial trust. Make sure your leases are in the name of the corporation for that beneficial trust. Now, what if I'm buying a property and I'm assuming the tenants that are in the property and there's already leases in place? What kind of documentation do I need to do then? Do I need to write up new leases for those tenants with my corporation, so that even though the terms can remain the same, but I need to do that?
Yeah, I typically would recommend doing new leases in that situation. If for some reason you can't, you can include that stipulation inside of the beneficial trust. So that trust agreement can be amended in some ways to be able to pick up the leases to be factored into it. But better recommendation, of course, is do new leases. At least it's your leases, it's your control, it's what you want to make sure is covered off in those agreements. And then at least you get a fresh set of agreements with the tenants.
That's awesome. That's awesome. So if I bought a property a while ago, maybe I've owned it for a year, 2 years, and now, like maybe my employment changes and my income goes up, or maybe I go from being an employee to self-employed for whatever reason that things happen. Can I now implement the beneficial trust process and use that through a corporation at that point?
Yeah, that's another good question. I get that commonly too, or sometimes I get it where somebody's got a property from like 3 years ago, and then they're looking at buying a second or third, and they're like, well, now that I'm getting more active in this, maybe it should be in a corporation. And the answer is it can be done, but it has to be careful, because CRA's rules also say that when you transfer property to something you control and own, it has to be done at fair market value. So if you bought a property 5 years ago, most likely it has hopefully gone up in time. So if it's gone up in time, we have two options. We either can declare a capital gain if we're moving it into a corporation, and a lot of times we don't want to do that because you're going to get taxed on it right away. The second option, and this is more common, is you can do something called a Section 85 rollover. And what that rollover does is it allows you to move the property into a corporation at the cost price, and the difference between fair market value and cost, you get issued preferred shares that you redeem over your lifespan. So it's a tax deferral that we can put into place to avoid the taxes on the capital gain that you incur. And in that situation, because we're most likely not going to go change the mortgage at that time, we're not going to go and re-qualify for anything. So instead, we'd also create the beneficial trust to then align it with the rollover to then make sure everything gets moved into the corporation. And going forward from that point, we can use the corporation only.
Oh, that's awesome. That's a great piece of information. Now, you mentioned something, couple of words in there called capital gains. And now there is something out there called lifetime capital gains exemptions. Does that play into this consideration of whether you have to pay capital gains on that rollover, or how could that work into this whole picture of choosing corporation or not? You know, if you're, yeah, you know, maybe you only own $2 or $3 million worth of real estate, and that's where you're going to be, you know, but you've got your lifetime capital gains exemption. Does that play into this picture somehow in these choices?
Yeah, it can for sure. So the lifetime capital gains exemption, what it is it's about 900,000 now, and it's growing to be about 1 million, and then I'll stop at 1 million. But it is on the sale of land, for example, or farm property, or the sale of shares in a private corporation. You can use this exemption, and every individual's entitled to it. So where it can become beneficial is if you're somebody who's looking at owning many properties, and that's the business, and we treat it as active income in a business, and you go and sell that group of properties, there is a chance we can use your capital gains exemption if you're doing a share sale. If it's 1 or 2 properties, we can't do it because they're passive in nature. But there's things now like with short-term rentals, Airbnb income, that's all considered active income. So if you're starting a business where you might have 5 properties and they're all Airbnb short-term rentals, and then you decide to go sell that business and the shares of it, you can take advantage of the lifetime capital gains exemption. So there is certain pockets where it can actually be taken advantage of in real estate as well.
So those the active flippers, that's there for them. The lifetime capital gains exemption can really help save them as well. So it's just a matter of choosing when and where to use it appropriately. So that's huge. And that active income versus non-active income, I guess that also dictates whether you have your property in a holding company versus an operating company, because active versus inactive income. So that's really an important conversation to have with the accountant.
Yeah.
So are there anything, and we've touched on this, I think, a little bit, but is there anything that investors should be doing to maximize the benefits of having an investment property in a beneficial trust to a corporation, or in a corporation purely?
For sure. So there's a couple simple things. So if you are using the corporation, a lot of times we look at setting up something called like a 3-tier structure, even where you might have a holding company, a real estate company, and then an active management company, for example. And so what that allows you to do is take your real estate properties where you might be earning passive income, and passive income gets taxed at a higher rate inside of a corporation, and being able to move some of it to a management entity where now you can actually get the active business income, right? Or if you're doing some of the Airbnb short-term rentals or flipping or doing that kind of stuff, if we can change your income from passive income to active income, you get a huge benefit from that end. And then other things that you got to keep in mind if you're using a corporation for real estate investing is the corporate structure. You got to make sure you're maintaining good books and records, like any corporation, right? And you got to make sure you're actually staying on top of your banking, and like we talked about, tell the same story. So you want your mortgage payments to come out of the corporation if it can. You want your rental income to be going through there. So just good business practices at the end of the day become important.
Oh, that's awesome. So, you know, one of the last things though is, what are pitfalls that investors need to be aware of if they want to use a corporation for residential investment properties? Commercial, completely different conversation.
Absolutely.
But for residential investment properties, what are some pitfalls that they should be aware of that they should be cognizant of as making that choice?
For sure. I think the 2 big ones that come to mind, of course, is cost, right? If you've got one property, one investment property, doesn't make sense to go through this whole process, incur the extra cost of having a corporation to then have it in that structure. Maybe, but it's something you got to really look at carefully. So cost is for sure a big one. And then the second other factor too is again, that personal income level. If you're somebody who's in a low income tax bracket already, then you really need to move it to a corporate structure where your tax rate might even be higher because it's passive income compared to your personal rate. So the biggest pitfalls is if you do it prematurely or you don't do it properly, it can actually end up costing you more.
Gotcha. Wow, that's huge consideration because everybody looks for the ways to pay less tax, but
Yeah.
the wrong choice based on the wrong information from not talking to the right professional can cost you more than taking the time to reach out to you and saying, hey, this is what I'm thinking. Am I thinking right? Am I making the right choice here? Because the wrong choice could really cost you.
Absolutely, yeah, man. And it's about doing that planning in advance too, right?
Yeah.
You don't want to wait too long before you're making this decision, because again, it could lead you to having made the wrong choice when you don't want that.
You'd rather take the time to set them up right at the beginning than have to take the time to clean up a disaster after.
Absolutely. Yeah.
Generally cheaper up front than after, isn't it?
Always.
Always. Well, Irfanali, hey, this has been fantastic information and highly valuable, I know, to my clients. If somebody wants to have a conversation with you and reach out to you, obviously they can connect through me, but if they want to get a hold of you directly, how should they do that?
For sure. So you can just look for us. It's RMI Professional Corporation on Google. Our website is accountantscalgary.com. And you can always reach us by phone at 403-457-4232.
Hey, that's amazing. I appreciate you coming and doing this for us today. And, it's such valuable and timely information because, boy, real estate investing just seems like it's taking on a whole new world, a whole new meaning here during COVID as people have realized things about their life and, things like COVID and the impact and how fast things can change. So very timely and a very important conversation to have.
For sure. Yes. Thank you for having me today. It's fantastic.
Hey, you bet. And we're going to chat again soon, I'm sure.
You bet.